A 1% difference. $300,000 gone. And dividend investors never see it coming. Here's the math they don't show you. Here's how it happens. Meet Daniel. He's 28. Makes $75,000 a year in the US after taxes. He takes home about $4,600 a month. He manages to invest $1,000 every month. He's disciplined. Now he faces a decision. Dividend stocks or a simple S&P 500 index fund? Daniel chooses dividends. Solid companies, about a 4% yield. His friend Alex chooses a low-cost S&P 500 index fund like FIOO. Same $1,000 per month. Same timeline. Different result. 5 years in, Daniel's portfolio is worth around $70,000. It pays him roughly $2,800 per year in dividends. Every quarter, cash hits his account. It feels like progress. Alex? His index fund is worth about the same, but no big notifications. No income moment. Just a growing balance. Psychologically, Daniel feels ahead. But investing isn't about what feels productive. It's about what compounds. GTX reality. Every dividend Daniel receives in a taxable account is taxed that same year. At his income level, that's about 15% federal tax on qualified dividends. So his $2,800 becomes roughly $2,380. The rest is gone. And there's something else most people miss. When a company pays a $1 dividend, its stock price drops by roughly $1 on the ex-dividend date. The dividend isn't extra money. It's part of the company's value being distributed to you and then taxed. Now yes, Alex's index fund also distributes dividends, usually around a 1.5 to 2% yield instead of 4%. But because index funds hold growth companies and trade less internally, more of the return comes from price appreciation, which isn't taxed until shares are sold. That delay matters, because taxes paid later compound longer. HE 1% GAP. Let's assume long-term market returns of about 9%. If Alex earns 9%, and Daniel effectively earns 8% after tax drag and slightly higher costs, that 1% difference feels harmless. But over 30 years, investing $1,000 per month, at 9% forward arrow about $1.8 million, at 8% forward arrow about $1.5 million, that's a $300,000 gap. Not from bad luck, not from a crash, just small, invisible friction compounding against you for decades. If you don't want to be on the wrong side of this math, subscribe now. In the next video, I'll break down the exact 3-fund portfolio that quietly outperforms most dividend strategies with less complexity. Now here's the part most dividend investors bring up. You might be thinking, but during crashes, dividends help you stay calm. Yes, they can. In 2020, when markets dropped over 30% in weeks, many investors panic sold. If receiving dividends is what keeps someone invested during volatility, that psychological advantage is real. Behavior matters. But here's the trade-off. Are you choosing dividends because they truly help you stay disciplined, or because the income feels safer? Most investors don't consciously decide. They react emotionally to visible cash flow, and they confuse income with wealth. Wealth is total return. Price growth plus reinvested earnings after costs and taxes. The market doesn't reward how often you get paid. It rewards how efficiently your capital compounds. Financially intelligent investors ask a different question. Not, how much income did I generate this year? But, what is my after-tax return over 30 years? They optimize for efficiency, low-cost funds, broad diversification, minimal turnover, long holding periods. Not because it's exciting, but because friction compounds just like returns do. Reduce friction, and you usually increase wealth. Daniel did something right. He invested consistently. That already puts him ahead of most people. But Alex minimized structural drag. And over decades, that difference created more flexibility, more margin for error, more financial options. Dividend investing isn't wrong, But ignoring math is expensive. Most investors won't run these numbers. They'll choose what feels safer. If you'd rather be on the right side of compounding, subscribe now. Next video. The simple 3-fund strategy that can turn $1,000 per month into $2 million without chasing yield.